I'm Jesse Mackey, CIO of 4Thought Financial Group, and this is 4Thought's weekly market perspective for the week of May 19th, 2020. Stock markets rallied strongly yesterday after taking a two-week breather from the huge relief rally they had experienced following a deep dive into a bear market during late February and most of March. The most recent low point for the S&P 500 index of U.S. large-cap stocks was on March 23rd, which pointed to dropping more than 34% from the record peak achieved on February 19th. Despite the steep rally in the time since, it remained 12.95% below its record peak as of the close of business yesterday on May 19th. Historical market type statistical analysis reveals that once a bear market is confirmed, which occurred on March 11th, the average time to the trough of the cycle is approximately 5 to 6 months later. The average additional loss is approximately 16.72% from the bear confirmation point, although both the actual time to the trough and the additional cumulative loss can vary widely depending on the specific time period. For long-term investors, this window has historically proven a very opportune time to deploy any excess cash accumulated in bank checking and savings accounts that is not needed for short-term expenses or savings goals, or to supplement household living expenses in the event of a temporary loss of earned income. In the current scenario, this cash deployment should take the form of an immediate initial lump sum injection of 70% of the total investable cash, with the remainder dollar cost averaged in 10% increments over the next 3 months. Long-term investors should immediately speak to their advisors regarding whether and how to implement this, based on their own particular financial situation. From a probabilistic analysis perspective, stock types range from slightly overvalued, in the case of large cap growth stocks, to moderately undervalued, such as with mid-cap stocks. Bond types range from moderately overvalued, in the case of long-term U.S. Treasury bonds, to slightly undervalued, in the case of emerging markets bonds. Against this backdrop, the outlook for stocks is now positive in the intermediate term, based on the overall aggregate of our historical market type data analysis and our probabilistic analysis. U.S. aggregate bonds driven by Treasury securities are the strongest performers so far in 2020, while U.S. small-cap stocks and global private equity show the worst year-to-date performance. U.S. mid-cap stocks now reflect the most attractive pricing relative to the alternatives, while long-term U.S. Treasury bonds are by far the least attractive. With regards to allocations amongst investment methods, we're now allowing overweight allocations to strategic asset allocation, neutral allocations to liability-driven investing, and underweights to selective, concentrated investing and opportunistic investing. I hope this was helpful. If you have questions or you'd like to discuss how to implement any of this, please contact 4Thought at 516-300-1617 or at info@4tfg.com. Thanks for watching, and see you next week.